All right, let's finish this up. So, I mentioned before that the dividends that we were dealing with were cash dividends, but you could also pay out property dividends. The other thing you could pay out is stock dividends. Now, a company could be paying out its own shares as stock dividends. So, you've all seen those movies where everybody goes, yay, 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 we're getting a stock dividend. The idea here is that a company may not have the cash on hand to pay out a cash dividend, but they want to reward their shareholders. So what they do is they pay out a stock dividend. Now, for a company, that's no cost. If you think about it, all they're doing is paying out some shares of their own stock. They're not paying out any of their own cash. They're not paying out any of their equipment. So it doesn't hurt them really in any way. What it could do, though, is bring down what it will do is it will bring down the market price of the shares that are out there in the world. And we'll talk about that in a few minutes when we talk about stock splits. Okay, but a company could pay out stock dividends. I just wanted to be clear about that. The other thing that could happen, and we did talk about this before, is when a company buys back its own stock, it could be called treasury stock. Well, it will be called treasury stock. All right, the idea is that it has been issued and then reacquired by the company, and they're holding on to it. Something that's not mentioned here is it actually carries a debit balance, because when you issue stock, it is a credit to common stock. But if you rebuy that stock, you don't debit the common stock. You actually debit this account called treasury stock. So it's almost like, I don't know that it's called a contra account, but it's treated as a contra account to common stock. Okay. Now the question is, why might you buy treasury stock back? Why might you buy your own stock back in the marketplace? Well, there's a couple of reasons. What if you were giving your employees a bonus and you paid them in the company's stock? Okay, that could be a way. Rather than taking the stock out of your authorized but unissued pile, you might buy stock out there in the marketplace and use that to reward your employees. The other thing that you would want to do is think about simple supply and demand. If you had tons of shares out there in the marketplace, and what's going to happen is if there's too many out there in the market, the price of the stock is going to get dragged down. So if you go out there in the marketplace and you start rebuying your own stock, there's going to be less of them in the marketplace, and it most likely will drive the price of that stock up because there's going to be few of them. All right? If you have too many, the price goes down. If you rebuy your own stock and you make it so there's less stock available in the marketplace for people to buy, that is going to bring the price of the stock up, presumably. Okay? So the simple journal entry for when you rebuy your own stock is simply a debit to treasury stock. As I mentioned, it carries a debit balance and it credits the cash. And you're not going to worry about what you originally paid, how much money you originally got from your stock. You're not going to worry about how much you originally got when you sold the stock. You're just going to record it for what you paid for it when you rebought it. Now your book goes into a bunch of more accounting for treasury stock. I think that a better place for that is going to be in intermediate accounting. So we're just going to touch on it lightly here. Now let's talk about a stock split. Okay, a stock split is, and this is where I was going back to, everybody sees in the movies, there's a 2-for-1 stock split or a 5-for-1 stock split. We're rich. That's not actually how it works. The idea is that once there's a stock split, it initially doesn't really mean anything to you, other than that you have more actual shares of stock. Now what I mean by that, let's say you've got a stock that's worth $100. Okay, you've got one share of stock that's worth $100, and the company issues a 5-for-1 stock split. So what that means is for every one share of stock, instead they're going to replace that with 5 shares of stock. So you're going to get 4 more. All right. So that one share of stock is being replaced by 5 other shares. It doesn't mean you get 6 shares of stock. It means it's kind of a 1-for-1. Instead of your one share of stock, you now have 5. All right. So the idea is you had one share of stock that was worth $100, and now there's been a 5-for-1 stock split. What that means now is you have 5 shares of stock worth $20 each. Okay? So you basically still have $100 of stock. You just have it broken down a little differently. Instead of 1 for $100, now you have 5 at $20. Okay, so a stock split doesn't do anything for you initially. All that it does for you is give you more actual shares of stock, and what you hope for in the future is that the market price continues to go back up to that $100 mark, and now you have 5 shares of stock to sell. But initially, It doesn't mean anything to you. So those movies, when you see those now, those financial movies, and everybody's going, yay, this split, we're rich, we're rich, we're rich. Yeah, no, that doesn't mean anything initially. All right? So just a visual representation of that. Let's say you had 4 shares of stock, $100 each, right? So $100 each. So you had $400 in total value. And there's a 5-for-1 stock split. Well, instead of 1 share, you now have 5, right? So for this example, you've got 20 shares because you had 4. Now you have 20. You still have $400 worth of stock. Okay? Nothing changes initially. The important thing to note is a stock split doesn't require journal entry. Okay? Nothing happens. And that's it. That's the end of your chapter, guys. I hope you enjoyed it.